Welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm Leslie Picker in for Bob Pisani today. I'm joined by Bank of America's Bartels and ETF.com's Dave Nadig. Let's start with the markets. The S&P hitting a new all-time high on the heels of the G20 meeting. This just after the index closed out its best first half of the year in more than 2 decades. And the ETF business has been booming as well. $120 billion pouring into exchange-traded funds in just the first 6 months of the year. And the kicker is everything seems to be working. Both stocks and bonds are up significantly, seeing big inflows. So what does this say about the overall market environment, and what should investors do now? Dave, what do you think?
Well, I mean, when we see this, what we're really seeing is investors reacting to what happened still from the third quarter of last year. I think fourth quarter of last year, a lot of money came out of assets in general, went to cash. And when that money came back, it went into everything related to ETFs, stocks, bonds, even commodities. We actually saw inflows into gold for the first time in a long time. So honestly, everything seems to be working with very few exceptions. A few sectors like energy and financials haven't pulled in extra assets, but pretty much everything else has.
How long does the hangover from the fourth quarter continue to work, though, Dave? I mean, you know, we're already looking at 2 quarters beyond the fourth quarter. Does that steam ultimately run out?
Well, the thing about ETFs is there are already 2,300 of them. So if you don't want to be, say, in U.S. equities because you think this run may be coming to an end, well, there's a whole raft of short-term bond funds and gold funds and alternative assets that you can allocate into. And that's what we're seeing. So when we see flows into fixed income, often we talk about that being a risk-off trade. Not this time. We're seeing money come into the long bond and all the way into the very short end of the curve.
Marianne, what do you see as the driving catalyst behind such strong performance in so many different asset classes in the first half of the year? What is it that's kind of propelling those moves and that performance?
Well, earnings really drive stock prices. And when you look at the earnings growth rate from about a year ago, earnings are up 27%. Now, we've had a lot of volatility. There certainly has been trade tensions, and we've had concerns about a slowing down of economic growth here and overseas. And what that has caused is many professional fund managers to kind of keep some dry powder, to be very cautious on the markets. And our recent fund manager survey showed that the majority of global fund managers hold so many defensive positions that we haven't seen these levels of concern since the financial crisis of 2008 and 2009. So even though we haven't had a recession and we've seen stimulus from the Federal Reserve and earnings have been strong, the commitments to the markets just haven't been there. So we still think that there's a lot of capital that can enter specifically the equity markets.
You mentioned that capital. Do you think it does go into the equity markets specifically, or are there other asset classes that could continue to benefit from this? Because as you mentioned, there are certainly some geopolitical risks out there, and other people look at valuations in the equity markets as a risk in and of themselves. Marianne.
Well, what's also interesting is the valuation from a year ago. The PE multiple has also come down on the market. So you have had some contraction. Obviously, you've seen some moves in the gold market. Gold is coming off, but you have seen some assets go into gold. You've seen some assets for the first time in a while go into the energy space. But when we really look at all of the asset classes between bonds, stocks, cash, and alternatives, we still think that there's enough good valuations within the pockets of the market. Technology, for instance, which is also reaching a record all-time high, that we think you're going to start seeing assets move probably into the higher beta parts of the market, also what we call lower quality assets, because they tend to have a bigger bounce within the market.
Dave, what do you think investors should be buying, especially those that are repositioning their portfolios for the third quarter and second half of the year right now?
Well, I mean, I think it really depends on your perspective on this run. I sort of agree. We're in this weird situation where, yeah, the market's doing well, but earnings are actually outperforming the market. So I agree. I think there's still room to run here. In that case, I also agree we should be looking at those higher beta plays. What that means is likely moves into small cap stocks, into mid cap stocks, into some of the sectors that don't necessarily make the headlines every day. So out of FANG, say, and into solid mid-cap and small-cap consumer names.
Marianne, does that higher beta play increase an investor's risk profile at this stage, though?
Well, it definitely would increase the risk profile. So we raised our tactical target to around 3,100 if we would get some kind of deal with trade. We really didn't get a final deal, but we're in a space where the markets, we think, can tactically rally. S&P up near 3,100. But we're concerned that we're going to maintain volatility because we don't have a trade deal. We think these negotiations are going to take some time. We've been saying no pain, no gain. So the risk is that by year end, we're pretty flat on the markets or close to 2,900. So we are cautioning clients that we still think we're going to have positive gains, but you're going to see a lot of volatility around that. But in the near term, we think the higher beta part of the market will continue to rally.